Hey everyone, we're back, and today we're going to cover a cash advance versus a balance transfer, what they are, and characteristics of each one, and how they're different. All right, Johnny. So let's start at the top. This cash advance thing. Explain what a cash advance is to me.
Cash advance is pretty simple. A cash advance is when you contact a bank and ask them to give you cash off of your credit card. When a bank gives you cash off of a credit card, they consider it a cash advance. And all major banks will have predefined terms on what they can do for you when you want to get cash off of a credit card. But it's important to know cash advances, phenomenal tool when it comes to getting some access to cash, but cash advances are expensive and cash advances have limits. If your credit card has, for example, a $10,000 limit, the bank might only allow you to cash advance $2,000 or 20% of your current limit cash off of the card. They won't let you cash advance the entire limit of the card into your bank account. They'll let you cash advance a portion of the limit into your bank account. And for the convenience and ease of access to that cash on demand, you're going to pay for it. Interest rates on cash advances are going to be higher than your purchase rate or your balance transfer rate. Typically, cash advance rates are going to be 20% or more interest.
Wow. So these things are expensive, right? And there's a time and place to do them, obviously. Otherwise, we wouldn't be sharing this with our clients. I mean, this is something that we teach our clients to do on a short-term basis, which we'll cover in other videos. This video is only about what they are and how they're different from balance transfer. So you're going to get something quickly, right? You're going to get this cash that you have available on your credit card into your bank account very, very fast. It's usually the same day, right?
Correct.
However, you're going to pay for it, right? So it's like buying popcorn at the movies. You know that popcorn is not worth $12. However, for a tub of popcorn, you pay $12 because you get it right away, and you have the privilege of taking it into the movie with you, whereas you can't take outside food unless you sneak it in. So this is like buying popcorn at the movies. There's a time and place for it. It's expensive. However, it's convenient, right? You're not making it. You're not microwaving anything. You're not going to the grocery store. So this, there's a time and place for it, like I said, and you don't need any debt in order to take a cash advance. So I could literally take my credit card. Let's say I have we'll just say Capital One, right? I have a Capital One card. I could literally go to my bank, and let's say I bank with Chase. I could walk in and say I want a $2,000 cash advance off of this Capital One card to go into my Chase bank account. And they'll do that for me, right?
If you've got your account number and routing number for Chase available.
Excellent. So cash advance, it's an expensive but quick way to get cash off, and there is a limit on how much you can advance. Now, this is different from the next strategy of pulling cash that we're going to share, which is the balance transfer. How are they different, Johnny?
A balance transfer is exactly what it sounds like. A balance transfer is when you transfer a debt from one account to the other. Balance transfers can only be used to move debts between accounts. So let's take two sample accounts. We've got a Capital One credit card with a $5,000 debt carried on it at 15% interest. Maybe we also have a Discover credit card with a $0 balance. And Discover might send me an email that says, hey, take advantage of a balance transfer. Transfer debts to your Discover card at 0% interest for 12 months. Would one consider transferring a debt from Capital One to Discover, knowing that they can bring their interest rate on a $5,000 debt down from 15% to 0%? Probably. Discover wants to hold your debt because when banks hold your debt, they make money. So Discover is enticed to give you a reason to transfer debt to their account. So a balance transfer is simply when you transfer a debt from one account to another account. In this case, if you transfer $5,000 from Capital One to Discover, then that will be a $5,000 balance transfer to Discover.
Got it. So Discover is physically taking money that you have available with them. Let's say you have a $10,000 limit, right? With Discover. They're taking half of it and they're sending a check for $5,000 or an ACH payment or however they do it, but they're sending money to Capital One to knock this out, right? And now you owe $0 to Capital One, and that debt got transferred over here, right? That's basically all it is. So, what are some characteristics of a balance transfer?
Characteristics of a balance transfer. If you want to transfer a debt, the balance transfer is initiated at the institution where you want to move debt to. In this example, we talked about Discover and Capital One. If you want to move a debt to Discover, then you have to contact Discover to initiate the balance transfer. You'll contact Discover. You'll tell Discover that you'd like to initiate a balance transfer, and then Discover will ask you for the information of the account that you want to move debt from. So you'll let Discover know that you'd like to initiate a balance transfer from Capital One, $5,000. You'll need to give Discover your Capital One account number and address for mailing payment, and then Discover will send out a payment to Capital One.
So it's somewhat slow, right?
This balance transfer process, after it's initiated, it can take 5 to 10 days before the payment clears to the it can take 5 to 10 days before the payment clears to the Capital One card.
Got it. Okay, so compared to the cash advance, it's a little bit slower. However, what's positive about it is you have more favorable terms, right?
Yes, and you're also typically not going to be limited by, well, cash advances, you're going to have a cash advance limit. Balance transfers typically don't have limits.
Got it. So you could use a full limit. Let's say your Discover is at $10,000. I could theoretically transfer all $10,000 to Capital One, right?
If your Discover card has a $10,000 limit, that would mean you could transfer up to $10,000 of debt to your Discover card.
Got it. So this example is equivalent to buying popcorn at the grocery store. You're going to get a tub for maybe like 50 cents or $1. However, you're going to have to go through that parking lot. You're going to have to wait until you get home. You're going to have to pop it in the microwave, maybe, melt some butter by yourself, and then enjoy popcorn. But you'll be able to enjoy it at a much lower price. So that's kind of the difference between a cash advance and a balance transfer. And pretty much that's the best way I could describe it. Is there anything else that you want to add on to that would add value to our viewers?
Cash advances and balance transfers are both very powerful tools, and you'll have access to both of them on your accounts.
Awesome. And in this video, we just wanted to cover the basics on what these strategies are. We're not going into nuts and bolts. However, in the next set of videos, we're going to cover each one in greater detail, how and when to execute them, and how you could take advantage of the cards that are basically dealt to you in either case and still come out ahead, right?
You got it.
Awesome. So with that, guys, we're done. Stay tuned for the next set of videos. We'll see you on the other side.